Howdy, and welcome back to a holiday shortened trading week. You know, the markets are in a good mood today. They're in the green and early going on news that steep EU tariffs are apparently getting a reprieve until July. Now, this makes absolute sense to me, and it probably ought to for you for all the reasons we've been talking about for months. Anything that even hints at certainty will be a boost in the scheme of things, and to the markets too. Now, that said, have no illusions though. The smart money is buying practically no matter which way the markets are moving. And I submit that you ought to think very seriously about taking a page from their playbook, if you're not already, using the right tactics to control risk and maximize opportunity, of course. Now, meanwhile, here's my playbook. Why you'll want to watch Nvidia's earnings like I do. Now, Nvidia reports tomorrow after the bell, and I'm expecting 55 to 60% growth or more on the top line, but about 20% or so on the bottom line. Interestingly, though, the numbers almost won't matter if Team Jensen does what I think they will. Now, I mentioned that this morning during an interview, a pre-opening bell conversation with the fabulous Stuart Varney, so you can watch that elsewhere on the channel. Stuart and I were also going to talk about Costco as well, but we got pinched by breaking news from U.S. President Donald Trump, who was posting about Europe appearing to have accelerated tariff meetings. Imagine that. Anyway, I'll have more on both of those things in this morning's OBA update and later this week. Number 2 today, if Tesla European sales figures bother you, all right, this is a big one. I want you to think about this. Time for some tough love. If recent reports about falling European vehicle sales in Europe bother you, you really ought to have a think. You ought to take a hard look in the mirror and ask yourself why you're investing. Why? Because calling Tesla a car company at this point is like believing that Apple is still just a computer company. Probably every bit as dangerous to your portfolio. Just saying. Anyway, if you can't get on board with Musk, that's A-okay. I get it. I respect that. No blood, no foul, as the old expression goes on the Harlem basketball courts that I used to play on in college. Just get comfortable with the fact that Tesla has returned over 2,000% over the past 10 years, the past decade, and it could easily do so again as robotics, AI, big data, energy, everything else comes into the picture. The S&P, by comparison, still did okay, 180% by comparison. Now, here's the tip you want to think about, right? Aspiring investors spend an inordinate amount of time trying to be right. The world's most successful investors, on the other hand, spend all their energy on being profitable, even when they're wrong. Yep, think about that for a minute. Number 3, buy this, not that. Costco, Macy's, and Dick's Sporting Goods all report this week. I think we're going to see very quickly who's swimming in the shallow end of the pool, so to speak. Not all retailers are built the same, so it is a mistake to paint them with the same brush. Now, I submit those that have pricing power, supply chain agility, and loyal customers who spend practically no matter what are the ones you want to buy. Those that are constantly fighting margin pressure, inventory bloat, and shrinking foot traffic are the ones you don't. Simple as that. So watch for clues as you listen to the earnings calls for the same thing I'm looking for. Tariff exposure, consumer resilience, and whether or not the value equation still holds. Now, in this environment, execution is everything. Now, by the way, I know which one of these companies I'm going to be owning, and respectfully I ask, do you? And the reason I bring this up is not to toot my own horn, because I could easily be wrong here, and I might be wrong tomorrow. I don't know. But the company that I prefer has returned 140% since bringing it to the OBA family's attention versus 30.8% from the S&P 500 over the same time frame. So, again, buy the best, ignore the rest isn't just a marketing mantra that I came up with. It's grounded in years of rigorous research, and it plays out at times like the present, which is why you want to decide for yourself what the best is, then make a point of owning it. Number 4, Salesforce made a genius move, and here's why I think so. Salesforce is acquiring cloud data management firm Informatica for $25 a share in what's about an $8 billion cash deal to strengthen its AI performance platform, Agentforce. Now, what's interesting about this is the move brings Informatica's data catalog, integration, and governance capabilities directly into Salesforce's AI stack. Now, the goal is to create a more autonomous and trustworthy enterprise AI agents, which I submit if you've talked to an AI-driven customer service agent lately is probably well needed. The thing that I want to point out is that this isn't just another software acquisition, but a strategic land grab for the invisible infrastructure that will determine who wins the arms race. Now, I don't like Salesforce as an investment and never have, because I prefer another stock with what I believe has far stronger sales potential, and profit potential. But I have always admired the way management thinks. This is a genius move, pure and simple. Why do I say that? Because you can't scale autonomous AI. It doesn't matter what kind of company you are. You can't scale autonomous AI without a bulletproof understanding of where your data comes from, what it means, and how it behaves. Informatica gives Salesforce that capability across the enterprise stack, from the data cloud to Tableau, MuleSoft, and beyond, to a point that we've talked about many, many times. The biggest winners over the next decade will be companies rewriting the foundational elements of our future, not simply repainting the room that it lives in. Now, presumably, you've got this covered with your own investing, but if not, I urge you to rethink that premise and to read Peter Thiel's book, 0 to 1, because N+1, a distinction you'll understand when you read it, won't get the job done if you're interested in seriously building your wealth. Now, number 5, I hate to bring this up again, but I've got to. Please be aware. The scammers are apparently at it again. This time around, they're using text, DM, and even voice messages, using AI to clone my voice, claiming to be me, offering crypto trading, trade cycle optimization, whatever the hell that is, and one-to-one coaching and more, all supposedly from me. Please block and report these folks immediately to Facebook, Meta, Instagram, X, YouTube, wherever these digital cockroaches are crawling. Loop in local law enforcement if you need to. So let me be crystal clear again, so there's no misunderstanding here. These messages, the type of stuff that you're receiving, are 100% fake. They are scams designed to separate you from your hard-earned money. I do not offer one-on-one coaching. I do not run crypto schemes, copy trading, or any of these other horse poop schemes that these jokers are peddling. I will never DM you asking for money, private access, or secret group invites, ever. Now, scammers prey on trust, so I submit, do not give them yours. Perhaps I'm in firm command of the obvious, but it seems to me that if these jokers spent half as much time building something real as they do running scams, the world would probably be a whole lot better place. Anyway, thanks for watching my 6, and keep your radar up. Now, today's bottom line: conventional wisdom is often the path to substandard results. I submit that the sooner you learn to think differently, the sooner your portfolio can thank you. As always, let's make it a great day and start the week strong. You got this, I promise, and I will see you tomorrow. Thanks for watching.